Hi, everyone. Welcome to another episode of Good Investing. I'm your host, Tim Nash. The green economy has grown so much over the last 10 years. Green technologies are way cheaper, and green companies are way bigger than they were a decade ago. But it feels bad right now. We've got 4 more years of Trump, and climate targets are slipping away while climate change is becoming worse and worse. It's a tricky time for green investors. To help us navigate, I've invited portfolio manager Martin Grosskopf, VP and portfolio manager at AGF Investments. Martin manages the oldest green mutual fund in Canada, maybe even in the world. Let's jump in. Welcome. We've got a great show lined up for you tonight, coming to you live from Toronto, Ontario. This is Treaty 13 territory, the home of the dish with one spoon wampum. Martin, I believe you're in the office downtown in Toronto. Is that right?
I am, yeah, right down
Amazing.
at the new CIBC Square building. So
all right. So you've got a fancy new office there.
Mhm.
People in the chat would love to know where you're coming from. If you want to let us know where, my dream is that we are going to have people from coast to coast to coast tuning in and joining the show. So if you want to let us know where you're coming from, that would be great. Really appreciate it. Awesome. So what we're going to do tonight is we've got Martin for the full hour, which is just fantastic. For those of you who are watching on YouTube or listening to the podcast, we are going to be splitting it up into 2 different episodes. So for the first half of the show, we're kind of just going to be talking a little bit big picture, talking to Martin about what happened with the U.S. election, kind of the macro environment, lots going on right now. People have a lot of questions about the green economy and as green investors, sort of where things are headed and just on a bit of a bigger picture, where we're at and where things are going. And then from there, the second half, we are going to dive in to Martin's product. That Martin Grosskopf is VP and portfolio manager at AGF Investments. So he is also the manager of the AGF Global Sustainable Growth Equity Fund, our impact investment of the month. So we're going to kind of take the first half, and the first episode is going to be a little bit more bigger picture and macro. And then we're going to dive into sort of the nerdy stuff in terms of what it takes to manage a green fund and how Martin does make some of those specific decisions. So as always, really want to welcome you to post questions in the chat. I'll do my best to monitor and keep track of everything. Love seeing where everyone is coming from. Owen Sound, Gatineau, Quebec in the house. I think I saw a London, Ontario, Madison, my hometown, Smithers, BC, Ottawa, Edmonton. This is great. Sudbury, Ontario, Ayeta. Hi, welcome so much. Love having people from across the country tuning in to talk about sort of what's next for green investors. Okay, perfect. Awesome. So Martin, thank you so much for joining today. Really appreciate having you on the show.
Yeah, it's lovely to be here.
Now, election night, we're about 2 weeks off. I believe it was almost like two weeks to the day here. So just want to get a feel for, your election night. Like, how late did you stay up? How did you feel the next morning? I assume you probably woke up and saw the results. What was going through your head and your heart as you saw those results?
Well, I can't really lie to you. I mean, the administration that we have is not the one that probably is most aligned with a green investment philosophy. So,
Yeah.
it was a challenging evening. I couldn't sleep too well. I got up, 3-4 times, and the numbers kept getting worse during the evening. There was at one point I thought that there was a chance of maybe some catch up. That didn't happen, unlike the last election. So, yeah, it was. In a way, a shock to the system. At the same time, I would have given it 50-50 odds going in. So I just had a more positive, bias, but it didn't work that way.
Yeah, I mean, I know I was preparing for, Trump to win for the, so the months leading up to it. We knew it was 50-50. I think we all knew that was a possibility. It's always hard. I always say sort of hope for the best, plan for the worst. So, I don't think I was shocked when I saw the results, but at the same time, certainly felt very, very disappointed in those results. We are going to be talking about markets and, sort of some things and forward-looking, opinions. So do just want to read the legal disclaimer here that the views expressed in this episode are those of the authors and do not necessarily represent the opinions of AGF, its subsidiaries, or any of its affiliated companies, funds, or investment strategies. So with that out of the way, Martin, you're now off the hook and you can tell us how you really feel about these things. Lynn said described as soul crushing. So, I think that, for a lot of us, we had that. When I woke up and, looked at markets, I did see there was a knee-jerk reaction, that we did see certain markets move rather quickly. How does it work for you? Like, what are you looking at on your screen? What kind of research are you looking at when you wake up and there is one of these sort of market moving events? How do you start to interpret that?
Well, I think first of all, going in, never give too much credence to polls, never give too much credence to political pundits. I mean, there's so many opinions for the year leading up to the election, and the reality is that we already started the Trump trade a year ago. There was some positive periods during this year where that was reversed maybe for 3 or 4 months, but by and large, we've had a Trump trade most of the year. So my expectation was actually that if he did win, you would see another knee-jerk reaction, but that this should set more of a substantial low. I mean, at least in the areas that we're interested in, that's kind of the playbook from 2016. Where a lot of sort of the green side of the economy did trade off fairly significantly, but then actually the administration under Trump didn't do much damage to the space. So in fact, it did considerably better than under Biden, despite the fact that you would have thought the opposite.
Yeah, I think it's really important to kind of disconnect the notion of stock share price performance versus sort of tangible results within the green economy, that so much of share prices are based on expectations. And I think that, my understanding of 2016 is that Trump came in and expectations were so low, but the green economy continued to do well. It continued to grow, maybe not as quickly as we would have liked and had there been more support, but it absolutely continued to do well. And then it was really interesting because when Biden won, like leading up to the Biden win, green stocks really like popped, but then there were such high expectations when Biden came in and then really didn't live up to them at all. And sort of the green economy did fine during Biden's tenure, but green stocks actually did fairly poorly if we look at it, especially sort of, from 2022, the last 2 years, really, I think the expectations were high and it was a little bit disappointing there. So it is important, I think, to distinguish the difference between sort of the green economy versus the green stock market. Do I have that right?
Yeah, I would agree with that. I think you need a baseline of supportive policy. I mean, there's no doubt if you dip under a certain level, that's a challenge. But there's so much that's going on at the state level. There's so much that's going on at the corporate level that is irrespective, or perhaps sometimes, in spite of federal action, the states like California tend to double down every time the feds, retract on something at the EPA level or elsewhere. They often actually put tougher requirements in at the state level, which is followed by others like Connecticut and so on. So there still is progress. There's still a baseline, and companies do have to plan beyond the next 4 years. So the worry from any corporate leader is the pendulum swing. And if they go too far in one direction, what does that mean for their capital plans, if things were to reverse again in 4 years? So they like to tend to go down the middle, right? And I think that's important to note. The other thing I would note that's absolutely critical is far and beyond the politics, it's the rate environment that matters to green investing, right? The lower, like you don't need 0% rates. That was sort of 2020, where you had a lot of fluff in the market. You had SPACs coming out, which were those special investment vehicles that allowed a lot of assets to go from private to public markets that weren't really supposed to be yet in the public markets. But an interest rate level that's low enough that, your discounted cash flows are attractive for long-term opportunities. Everything we talk about is longer term focused. If you're investing in a water plant, you're investing in a renewable energy facility, you're talking, 20-year type discounted cash flows, and higher interest rates do impact your present value of those investments. And that's really important for investors to understand.
Yeah, I think that's a great point. I think that in the short term, the stock market is a bit of a voting booth, like it's based on sentiment and kind of rumors. But in the long term, it really is a weighing mechanism that per share
Mm.
prices in the long term are supposed to weigh those future profits, discounted back into today's dollars. And that it's a really good reminder that we're not day traders, we're decade traders. Right. And so when we look at this from this long-term, decades-long perspective that, this green transition is happening, I think that Trump and, federal support in the US can certainly slow it down realistically, but I don't think there's any stopping it. And I do think that people put a lot of emphasis on sort of the emotional, that kind of knee-jerk response to what they think this means for share prices, when to your point, it really is bigger things like the interest rate environment and these broader sort of, macro environments that are going to have a much bigger impact on green stocks than, anything Trump could do. Do I have that right?
Yeah, for sure. I mean, this is one of the reasons why it's been, let's say a challenging market for more thematically focused funds in the green area than the broad market. The broad market has such mega cap companies that are delivering massive cash flows. Think of an Amazon, or an Apple or a Microsoft. Not necessarily great green angles there, but they're delivering a lot of near-term cash flow, right? And when
Yeah.
investors are a little bit worried about where rates are at, they're going to flock to that type of investment. And so, that's why sort of the broad benchmarks have done so well, because they're dominated by these trillion-dollar companies now, right?
Yeah.
And it's not necessarily a diverse index, but it's one that, look, if you got a low-cost ETF and you're taking part, that's fine. Not really so much of a green angle there, but broad markets have done pretty well.
Yeah, I mean, certainly it's been an incredible, really year in the stock market, broadly speaking. And that it is a good reminder again that as well, these things are global. I think it's really important, we tend to get focused on Trump and the US obviously is a huge player in the global market. But even when I look at the stock market and these big companies, and whether it's, the big ones like Apple or Nvidia, or even some of the green ones like Ecolab, but these are global companies that even the ones
Mm.
that are listed on the US exchange very much are globally diversified. Lynn says if they want to trade with Europe, I mean, definitely it'll be interesting to see Trump's policies. We don't have the crystal ball. We don't know exactly what he's going to be doing there. But, it really is, I think, now important to stay globally diversified, and make sure that, and also understand that even the US market, these are global companies that are listed on the US exchange. And speaking of sort of the global situation, because there has been a lot of stuff going, sort of beyond just the US election right now. We just had COP16 on biodiversity in Colombia. Right now, we've got COP29 in Azerbaijan. But it feels really pessimistic on a global scale. Like this kind of does feel, to me, it feels like a farce. Like I'm seeing things in Azerbaijan and it's just not, I don't have any, faith or trust that we are going to have sort of a global solution coming up anytime soon. And, I guess my question for you is that, around these conversations about biodiversity and climate, like, how bad is it? Like I'm
Mm.
seeing a lot of bad news coming out and it certainly feels pretty helpless, but like what are you seeing?
Yeah, I mean, there's no doubt sort of on the environmental data side of things. I mean, it's not particularly invigorating what we're seeing, whether it's, species loss or ocean health or temperatures for that matter. I mean, we had the warmest August or July that we've had on record this year. The last decade, for instance, has been the warmest decade on record. So, the trends are not going in the right direction from purely the environmental data standpoint. That being said, there has been tremendous progress in some areas. I mean, when we think of, the commitments that have been made to net zero, whether it's at the government level or the corporate level, I mean, I couldn't have envisioned that 10 years ago that that would happen. So, if you look a bit longer, I mean, there's no doubt that uh, there's definitely, a movement. There's efforts being made. I think the recent talks, like, the talks around nature and biodiversity in Colombia, we're building on what happened in Montreal, where there was commitment made around a biodiversity framework that would try to protect, 30% of areas globally. So I guess that was tremendous that happened a couple of years ago. What's a bit frustrating is that you haven't seen many countries actually put forward those plans to do that.
Yeah.
There's intent, but then you need the reality of how you're going to do that. So I think that sort of bogged down a little bit in Colombia from my reading. Aspects that came out of Colombia that were resoundingly positive was greater indigenous involvement. This had been something that had been fought for over the years, and in this case, you had indigenous communities who were very much at the table and recognized as the key participants and often the key protectors of stores of biodiversity. And so there's an element of something that probably most are aware of if they look at biotech or the pharma markets, but there's also increasing interest in protecting and transferring funds to countries that are storehouses of bio data that's being used for sequencing, genetic sequencing in the biotech space. And of course, if you've been protecting plant species for thousands of years as an indigenous community, you'd like that to be recognized in some fashion. And so that, I think, was a positive happening within that COP16 process.
Yeah. I mean, Lynn says GFANS, which is I think, Global Financial Alliance for Net Zero. I'm going to go. Did I nail that acronym? I think I got that right. Just posted a consultative document that points to that net zero will only be achieved with nature, which I think we are starting to look at some of those solutions that is less about sort of tech solutions and really understanding the role that nature and biodiversity plays in the solutions. It would be great if we could pull together like we did for ozone. So yeah, like that was the Montreal Protocol. That's something that I point to as a really great, time. This was the idea of the hole in the
Lots of
ozone
good things
layer.
happen in Montreal, apparently.
Right. Let's absolutely. And, but that's a time where it was a very simple solution. We got
Yeah.
a price on CFCs and, alternatives emerge and we were able to solve that, pretty quickly and with a global alliance. So, I think to me, it's understanding my opinion is that the sort of the climate negotiations are so fractured. It's so
Yeah.
political. It's so tricky right now. I really do think we need to look at other places to be able to find those signs of optimism and progress.
Yeah, I
Uh,
think Baku is like it's maybe there's going to be less progress there than there was on biodiversity, honestly. I mean, it's biodiversity discussions are at an earlier stage. There's maybe more low-hanging fruit to attain. But obviously with the US pulling out of the negotiations in all likelihood and perhaps the agreement, it's going to be challenging. Argentina obviously was taking the lead from discussions with Donald Trump, where they've already left the negotiations in Baku. So that's not great. We'll see what comes out of it. It's still ongoing. It's been a week in the making here, but there's certainly, there isn't the commitment yet to sort of that move away from fossil fuels that we had hoped for. In fact, that discussion doesn't seem to be progressing much in Baku. Big surprise given where it's being hosted.
yeah, and,
Um,
and given the number of oil and gas lobbyists that are there now,
Yeah,
right?
yeah. So
And
the shout out I would give is honestly to the negotiators that are there that are trying to, put their pens to paper and come up with agreements because it's just tough work, honestly. It is a long slog. These people are like, sleeping in their chairs and they're trying to do what they can do, right? Then there's all the interference that's going on, and that's a whole nother story.
yeah, yeah. And I mean, I think that we are looking for leadership in other areas. Lynn says some, serious corporate leadership from Canadian companies. We need companies step up. We need state governments to step up. We need anytime there is sort of a bit of a power vacuum, really interesting to see who does emerge there. And, just a reminder that to me, it's the philosophy is always like, let's be kind to individuals. Let's be, really harsh on systems. And so
Mm.
understanding the power dynamics that are at play there. One thing that I'm seeing is a real sort of shift in the language where we used to see a lot of conversation around green finance. I'm starting to see a lot of talk about this idea of like transition finance. And I think they often get mixed up. Can you give me a quick little sort of description of what's the difference between sort of green finance versus transition finance?
Yeah, I think it has been confused to some extent in the marketplace. I mean, certainly with the strategy we'll be talking about, the global sustainable strategy, we're trying to keep it squarely on the side of greener. I think the transition side of things are often assets that might have very significant carbon footprints, emissions footprints that are looking to make investments to reduce those over time. And there's nothing wrong with that. I mean, that needs to happen. But I think it needs to be distinguished from companies that are already green in terms of their footprint on a relative basis, have already made those investments, and are well placed, for any increase in carbon pricing, for instance, taxes, trading markets. They're in a good position, right? And so I think with especially with investors, there just needs to be that distinction. I mean, if you're mixing the two, fine, be clear about that.
Yeah.
But if you're giving the impression that you're a green fund and you're mixing in a bunch of stuff where it's just hopeful anticipation, I think that's where you need to be careful.
Yeah, I mean, I'm seeing a lot of greenwashing. Lynn says, yeah. I mean, I think transition finance definitely it doesn't, it certainly doesn't come across as nearly as pure from I think our perspective as green investors, where we are looking for something that is more directly green. That said, I think there is a lot of work in terms of decarbonizing energy intensive industries, and that so it really is I think tricky this idea of my understanding is that transitioning means that you can invest in things like oil and gas companies, but that they would be using that money for things like carbon capture and sequestration or for energy efficiency measures. Whereas really when we talk about green finance, it's much more about investing in the direct solutions that are really kind of improving the situation. Is that fair?
Yeah, it's a very, very important distinction. And I think, the challenge with transition, it needs to happen. There needs to be significant capital. Just think of a steel mill or a cement industry. They have huge footprints. They're needed industries and they need to transition. But what can happen is that intent can fall off, right? I mean, just think about a change in government.
Yeah.
So you had planned to invest in converting to an electric arc furnace or something, and then the dynamics change at the political level, and you say, well, I'm going to defer that capital and increase my dividend instead. So what happened to the transition, right? That's the challenge.
Yeah, I love it. And, Lynn asks, what role will regenerative finance have in this discussion? So let's break down again some of these terminologies because I think it really is shifting that we kind of, over the last few years, there was a lot of talk about ESG. That was the big acronym, environmental social governance. I feel like it kind of had its heyday in sort of 2020, 2021. And then, there were a lot of criticisms that emerged and a lot of them very valid criticisms. And that really now what I'm seeing is this almost like evolution, or at least in terms of green investors, really understanding that ESG doesn't go far enough for a lot of people. I think there's this shift happening from ESG to thematic funds, and then even further to impact, which is, where I think this idea of regenerative finance comes in. Martin, can you kind of, walk us through this evolution from ESG to thematic and then to impact investing?
Yeah, I think if you view it as a continuum, the ESG strategies may be applying some factors that allow them to maintain, fairly close attribution to a broad benchmark. You will see a lot of ESG funds own Microsoft, they might own Amazon, they own a lot of the big names because they don't want to get off those names. They may be suggesting that they're applying some additional filters to reweight a little bit relative to that index. When you move over to thematic, you're investing in companies that are really providing those solutions that you mentioned, and certainly you're much further off benchmark from a sector perspective, often a market cap perspective. So you've got a different set of holdings entirely. You own them specifically for the potential that they show, growth from those solutions. And then when we think of impact, it's kind of another segment, I say, from thematic. You're actually looking very specifically for the indicators of that success. So it's not just, necessarily, do I own a company that offers a green solution, but in fact, can you measure what the improvements are that are coming from their products? In the public markets, it's a challenge to show, for instance, additionality. That's a term that's often used in impact. You can show intent. Clearly, we do this with intent, but measuring additionality to say it's just my money that's causing that impact is difficult in a larger company context. But I think you can show measures that at least are providing some indication, and that's what we're trying to do.
Amazing. And the framework that I use, longtime listeners will recognize that I talk about sort of investing, that we're kind of building a pie, that we're sort of building our pie chart, that most of your pie should be what I call doing less evil options. And this is where ESG is really going to fit into it. That's also where we talk about divestment. That's also where we talk about shareholder engagement. So pushing companies sort of, in the right direction, and really looking at being, sort of earning those market rates of return, but doing less evil, right? And that with your stocks and your bonds, that really is sort of like the core of your pie. If the bonds are sort of the crust of the pie and the stocks are the filling, that doing less evil part, really should be the bulk of your pie. And then to me, thematic investing is kind of the whipped cream or the ice cream on top of the pie. You don't have to do it. Not everybody likes whipped cream on their pie, but a lot of people do. I know a lot of people in the chat, in the audience here, want to invest in green. I don't want people going, putting all of their money into these green sectors or into these green funds because they're not as diversified. You use this language that there is sort of a little bit more dispersion, or that you are kind of deviating from the benchmarks when we're doing these thematic investments, such that we want to be careful about only carving out part of our portfolio to invest in these green funds. And then to me, impact investing is really the cherry on top. That this isn't something that, everyone has to do right away. But for those of us that are interested in building a more regenerative economy, that really, if we are impact first and willing to sacrifice financial performance, by taking on more risk or having a slight lower return, that's where we can look at these things like community bonds and, microfinance and these real sort of like crunchy granola impact environments that I think are really fascinating. Lynn has a great comment here. One of the far too common weaknesses is the focus on the effects of the environment on the organization, product, asset, or activity, but they're not looking at the impact that those elements have on the environment. So I think this is a really, really cool distinction here, understanding that ESG, we're looking at sort of risks and, understanding how these outside things are going to affect the company, right, and the activity there, versus I think what we're really trying to do here with what you're doing, and with oftentimes we are seeing that the theme, that the sort of thematic fund is impact, that we are looking at the impact that these companies are having on the environment, are having on people and the planet. Does that resonate with you?
Yeah, I think, the early days of ESG, I mean, even when, we were working on the terminology around ESG back in sort of a UN asset management working group that I was involved with back in 2003. I mean, that was the distinction, right? It kind of came from socially responsible investing. Then we said, well, it's a bit value laden using those terms. ESG term was introduced really to get it on the risk framework of large pension funds, right? It became too successful in that regard, right? Because then it became something where it was like, well, yeah, let's, to Lynn's point, just look at the impact on our investment, our company's performance, right?
Yeah.
Losing track of the long-term objective, which is, well, we're trying to improve these things, right? That is really the whole justification for adding in these additional areas of interest into the markets and really make a more social market and more environmentally aware market.
Amazing. Now I'm going to put you on the spot a little bit because we're getting towards the end of our sort of, bigger picture conversation here on the macro side. And that really, I think, that when it comes to like, Trump winning the election and what's happening, like I want you to sort of use your crystal ball just a little bit for me. So far I'm hearing that, this notion that, oh, stay calm and rebalance and, we're decade traders, not day traders. Like it shouldn't sort of fundamentally change things. But I kind of want to put you on the spot a little bit and like understanding like what does this really mean for green investors? Like how has this changed your outlook and your your investment approach going forward?
Well, so there's areas where I would just be a bit cautious until, the change in powers occurred, until the first shots across the bow come out of the administration. I mean, I don't expect seminal pieces of legislation like the IRA just to disappear. They're benefiting Republican states even more than they're, benefiting Democratic states.
And I'm just going to
So,
jump in here. The
yeah,
IRA is the Inflation Reduction Act. Sorry,
yeah,
acronym alert. Not everybody knows this. This was the Inflation Reduction Act. This was the bill that Biden passed that put a lot of money into green companies. Forgive the
right.
interruption. Go ahead.
Yeah. Yeah, and so there's a variety of elements there where companies benefit from manufacturing these products in the U.S. It's a protectionist piece of legislation, so it dovetails well with what the new administration will want to accomplish. It benefits battery manufacturing, renewable power, for instance, hydrogen, carbon capture. And so we think core elements of that will remain in place, but some will disappear, right? And the first thing that will happen is probably the consumer-facing tax credit for the purchase of an EV will disappear, $7,500 in the US. Musk can probably live without it, right? And so he's okay. Like Tesla will probably still do enough volume without it. It's going to hurt probably more the larger names like a Ford, or not larger anymore, but the more broad names like a Ford or GM. So that's an area we're cautious on until that's gone through. I think the renewable power space will be fine, especially given the amount of growth coming from new areas like data centers. So they need power, and it doesn't well, it does matter if it's cleaner because they've made a lot of corporate commitments, and it's Microsoft, it's Google. They're going to stick with their commitments through this administration, and so they will ink deals with solar and wind companies as well as nuclear, for instance. Potentially some nat gas. That's where it's a little bit browner. So those areas will still be strong. Water will chug along. I think it's a populist issue. Nobody wants contaminated drinking water. They don't want wastewater going into their beaches. So I think there's going to be continued investment there. But let's face it, there's going to be elements where a guy like Musk is apparently going to go in with this efficiency mandate and just find pieces of regulations he can get rid of, right? So I don't know where that ends. And so in some areas where you're getting a lot of funding from the federal government to do environmental studies, for instance, we're cautious in areas like that.
Yeah. Awesome. Okay. That makes a lot of sense. And to me, it's just understanding that, there always has been part of the green economy that has been dependent on government support, whether it's because it's a young industry that needs, subsidies and support to help it grow, or just things that, the financial markets tend to ignore, where they're just externalities that, the only way to really address it is through sort of government intervention and regulation. So I think that, those sectors are, they're going to be hit a little bit harder. Whereas I do think that there's a lot of opportunity when it comes to some of the, I call it the more boring green sectors, but these are things that tend to be able to stand on their own two legs,
Yeah.
financially speaking. And I think there's still a lot of really good opportunities there. Question from Lynn here is thinking about we're going to get into the fund in a minute, but, are you thinking about, a little less exposure to the US and a little more exposure to other countries as it relates to the green economy?
Well, I'd actually say, just from an allocation standpoint, I think it's a good time to have a higher weight in the US. I mean, there's going to be such an element of protectionism to this administration that, for instance, small mid companies in the US with entirely US revenues are going to be in a better position. If you've got a global supply chain, you're looking over your shoulder now for the next 3 years, right? Just
Mm,
wondering what part of my supply chain do I have to worry about? And I think that's gonna be impactful. So we'd actually be going the other way a little bit and saying let's just stay safe, let's stay North America a little bit more, and wait and see what happens with the rest of the world. I mean, I think Japan looks solid. There's names in Japan we like that are doing fine regardless kind of what happens in the U.S. Same story in Europe. Europe seems to be the sick child on a continual basis of the global economy, but there's still tremendous opportunities. Especially, I like the built environment areas in Europe. So think building efficiency and improvements from the sort of energy envelope of buildings. We have some good names there.